This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Ben Carlson. Ben is the Director of Institutional Asset Management at Ritholtz Wealth Management. That would be Barry Ritholtz's firm. Ben first gained quite a bit of acclaim with his blog, A Wealth of Common Sense. Following on the blog's success, his book, A Wealth of Common Sense, Why Simplicity Trumps Complexity in Any Investment Plan. Investors and traders can always have debates about the exact particular style of any one strategy. But there has to be some pragmatism at the foundational level. There has to be clear thinking early on. I think Ben does a great job bringing across clear thinking to investors. One can quibble on the margins. One can argue over this strategy or that. But clear thinking is absolutely 100% the bottom line. I hope you enjoy this conversation with Ben Carlson. Okay, Ben, so I'm going through this relatively new work of yours, A Wealth of Common Sense. And I think one of the first things that comes to mind for me, given your experience so far, how many people, and I guess I don't know how to really put this, to quantify it or frame this term, but in the investment community, which includes retail investors, institutional investors, how many people need this message that you've put together, this simple trumping complexity? How many people need this message? There must be a drive or an inspiration for why you felt the need to put this very pragmatic work out into the public.
I think it's actually probably more investors than would be willing to admit to themselves. And I wanted to write the book for a very wide audience, not just individual investors, not just institutional investors, not just people on boards at these institutions, but everyone. Because I think everyone could use a simpler decision-making process. And that's all that I want to do, is just sort of help people make better decisions and not become their own worst enemy when they're making their investments.
Even though we're many years removed from, let's say, the NASDAQ bubble, we're many years removed from the 08, 09 bubble period. I mean, to put this work out, you must have some deep conversation with yourself where you're saying that a significant number of people have still not put the right thought process together for investing. Well,
yeah, it's like I said, we're kind of our own worst enemy in that everyone really has this short-term mindset, and they're always constantly fighting the last war. What we do is we kind of have these haphazard investment plans that just sort of go from cycle to cycle or fad to fad, and they don't really take that sort of big picture context into perspective, and they don't really try to have an overarching philosophy, whereas they're just sort of doing a piecemeal approach, which is a great way to completely do what just worked in the past and not figure out what's going to work in the future.
That big picture philosophy, I think one of the things we've seen in the last 15 years, and I would love for you to offer some comment, your perspective, but the behavioral side of the equation, the emotional quotient, so to speak, this is something that's relatively new. And I wonder too, with so many advisors and fund managers, sometimes it's kind of like just the facts, ma'am kind of thing. It's the Joe Friday thing. But this bigger perspective really requires an internal focus, an internal looking inside, doesn't it?
Yeah, that's true, because it's really about knowing yourself. And it's not so much about beating the market, it's about not beating yourself, because so many investors, when you look at the stats, they're not just underperforming the market, they're underperforming their own funds that they hold. So it's bringing it into that basic level of, let's try to do what's right for us first, and then figure out if beating the market makes sense. And and so it's just really about knowing yourself and your own personality and what makes you tick and what makes, what works for you. And I think that that behavioral finance stuff that, like you said, it's just really coming into fore in the last couple decades is such an important aspect of it, because if you don't know yourself and know how other investors react and how human nature works, you're never going to make it in the markets, because that is such an important piece.
As we talk about the behavioral side of things, help an audience out there. There's a significant part of let's say the United States population that intimately remembers what 2000 to 2002 looks like. They intimately remember what the fall of '08 felt like. I mean, there was literally that panic of like, hey, are the ATMs going to work? Now we have this unique situation, perhaps, maybe some people might not say it's unique, but we have this situation where we've had this great run in stocks. How does one put aside that fear that we felt like we've been to the breaking point twice in the last 15 years. And of course, we all learn from experience, and we want to say, well, gosh, we felt like we're at the breaking point twice. How do we know we're not at another breaking point? But I'm not even getting to the point of like where we are today yet. I'm not even getting to that question, but just the big picture issue of fear. I mean, some of this fear is actually rational, isn't it?
Oh, yeah. And I think as investors, we're really shaped by our memories. And you talk about the ATM thing. It's hard to believe where we are today versus where we were then. Because I had people in the fall of '08, I had some friends in the hedge fund community reach out to me when Lehman went down and said, go to the ATM and get as much money as you can. I don't know if we're going to make it through the weekend. I mean, it was scary. And I think some people maybe have already forgotten, but some people, I think that they're really scarred by that event. And I mean, it really did seem like the system was going to go under. It was a possibility. And now I don't think anyone could have expected that we would be where we are today, 6 or 7 years later. So investors, I think, are kind of on the fence. They know that possibility of a system-wide crash is there, but they have these goals and these dreams that their portfolio is trying to help, and they need to make returns. So there's this dichotomy of balancing these risks with the long-term needs. And one of the biggest risks I see these days is that people are living longer, so they need higher returns. But people are still, I think, scared of what happened.
Well, you make a good point about living longer and higher returns. And I still remember talking to my CPA in late 1990s, starting a business. And he said, Mike, just get, XYZ amount of millions in the bank free and clear. And, it's 6% for every million, get even a couple million. You're going to be, you'll never have to think again. All your daily expenses will be covered. That logic of interest income is really, it's not discussed that much today. It still feels like, hey, this is the penalty we had to pay for 2008. Like, we've got a great stock market now, but interest income is gone.
Right. There's no more. I wrote a post about this the other day. There's no more moving to the beach and living off of the interest income anymore, because it's effectively gone if you want high quality bonds. That's something that people are dealing with, especially those who need their portfolio for spending needs, like you said, because you have to balance those short-term needs with those long-term goals. That can be a tricky balance to take, because trying to figure out your need to take risk and your ability to take risk is very hard for people. We've kind of
maybe stumbled into an issue, and I'm curious your perspective on it. But we have to think longer in life now. That we don't have the, I get to a certain age and the income's just going to come in for doing nothing. That type of retirement is kind of over, isn't it?
Yeah, and the weird thing is that a lot of people don't get is that retirement is a relatively new concept. It's only in the last 40 or 50 years that people have really had a couple of decades in retirement to actually plan for. In the past, I mean, there were pensions that people had, but it's also true that in the past, in say the early 1900s, people really kind of worked until they died. And so this retirement concept is something new. And I think we have this huge baby boomer generation, which I think the stat is something like 10,000 are retiring a day for the next 20 years. And these people are going to hit that point and realize, now what? What do I do? I have 2 to 3 decades to live and plan for, and I don't know if I'm ready for it.
Yeah, we've created an expectations conundrum. I mean, how do we get out of this?
Yeah, it's funny. You see all these articles every day talking about the retirement crisis, and I don't think it's quite as bad as people think, in the fact that I don't think we're going to be having nursing homes with bread lines, and that sort of thing. But, people are going to have to change their expectations. They're going to either have to work longer or save more, or they're going to have to really ratchet down their lifestyle when they retire. There's not very many easy choices for people that are unprepared.
Now, some people might be listening and they might be thinking, hey, you two, forget that. Just tell me the portfolio allocation. I don't need you to lecture me on the expectations of retirement. But then again, that is part of the whole equation, isn't it?
Right. And that's kind of what I tried to get in my book, where I didn't really give a general strategy that everyone should follow, because I think that there isn't just one strategy for every person. And it really requires context and situational awareness to really understand your own circumstances, because your circumstances are not the same as a billionaire hedge fund manager who's giving you investment advice. So it has to really be situational dependent, and depending on your own circumstances, what your salary is, what your spending needs are, what your savings rate is, all these things that people don't really, like you said, don't really want to worry about. But those things are very important. You have to have all that stuff set up front before you can then implement a strategy and really figure out your own system for investing.
You talk about it in your work, and I would love for you to expand on it some more. And you just kind of hinted at it. Envy raises its ugly head when it comes to investments, and envy doesn't help anyone.
Right. Yeah. That's what I think. There was an old Charlie Munger quote where he said, envy is the worst of all sins because no one has any fun doing it. It's the one thing you can't have any fun doing. And so it's this whole relative game, and it's so hard to do for everyone. Even if you recognize that fact, it's hard not to look at what your neighbor's making on their penny stock portfolio, or how these CEOs, how much money they're making. It's really hard to just focus on your own life and your own lifestyle and what's working for you and what your investment returns are. And I think that's one of the reasons that so many people have such a hard time investing, and they underperform the markets, because they're constantly tempted to try something different because they see someone else doing something that's working, and they can't just focus on their own process.
And that opens up a Pandora's box of other discussions. And I will use the catch-all phrase of noise. There can't be any way that somebody growing up in the 50s or 60s or 70s can necessarily relate to the amount of noise today, because we have what is it doing to us in terms of our decision making? The extra stimulus that we have coming at us, and then we are supposed to block it out. I sometimes really feel lucky that I kind of can remember pre-internet and post-internet. Some people are never going to experience pre-internet, and I think they might not know that noise is even noise.
Yeah, oh, definitely. So I have a young daughter at home, and my wife and I talk all the time about how much different her life is going to be for this technology, and even from what we've experienced. But the amount of information that's available these days is insane, and it's really a double-edged sword, because we're more informed than ever. But in many ways, people are they're bringing in information, but they're not really trying to put it in the correct perspective or context. So they're consuming as much information as they can, and they're reading as many blog posts as they can, but they're not stopping to think for what it means to them. And it's just more and more data and more research and analysis. But like you said, that the distance between that signal and the noise seems to be getting wider and wider. And data and information is free to everyone these days, which is pretty crazy, because a lot of the barriers are broken down. Globally, people can, in different countries who could never have hoped to compete with America before now, can do almost anything because with an internet connection. But understanding what that, and conceptualizing, what it means to them, and then sort of sifting through what's important and what's not, is really going to set people apart. And I think you're right that people are really missing that in this whole information age.
I love the idea of simplicity and getting people to understand simplicity from another perspective. And then another perspective that you use in your book, and I would love for you to elaborate it, a great documentary, and that's Sushi, and that's Jiro in Tokyo. Because here's an example of somebody that is using very simple ingredients. Everyone knows the ingredients, but that simplicity is part of his secret. Why don't you talk about why you decided to use that example in your work?
Yeah, it was one of those movies where the light bulb went off when I watched it, and you hear the quotes, and you see how disciplined this guy is. And, everyone thinks he's the best sushi chef on earth. And His restaurant is in a subway station. It's amazing. And people pay top dollar. People travel to the country just to have this guy's sushi. They were all the restaurant critics were saying, he's not doing anything different. He's doing the same thing over and over again and perfecting it. So it's not so much that he's taking all these chances and he's trying to reinvent the wheel. He's just very disciplined, and he uses his same exact process every time, and he's really just crafted that over many, many decades. And again, the restaurant critics couldn't believe. They said, when he tells you how he does it, it's so simple, but he just does it better than anyone because he just works at it, and it's more disciplined than anything.
You talk about that working at it, and we're talking decades of time and putting in the time and the effort and the energy. But then again, we have a situation where still a significant number of investors, for example, and you talk about this in your work as well, still imagine the holy grail of I'm going to do, 100% this year. Or they're going to beat the market by some obscene amount. There's just this desire to look at zero and say, well, that counts for him. I don't have to look at that lifestyle because I know the secret. I have the secret decoder ring. I can get around all that discipline. I can get around all that experience and all that effort and all that time because there's a shortcut.
Right. And everyone, and that's why so many get rich quick books continue to sell, because people just crave that. They know that it's not there, but they crave that holy grail and that get rich quick scheme, and they just want to make it easy. But they don't really know why. The patience is one of the things that is really lacking. And again, I think that's part of what we talked about earlier about the information age, is that you can get anything you want now these days at a click of a button, basically. You don't have to wait for anything. And one of the things you do have to wait for 99.9% of the people is getting rich. It takes time. And the whole focus on short-term outcomes as opposed to a long-term process, I think, is where a lot of investors really make the biggest mistake.
Let's talk about some of that noise in a little more specific manner. The narrative. We live in a narrative age. And for example, right now I can look at the narrative and I can say, okay, there's the doom and gloom side. The next black swan is coming. Then the other side says, I believe in Janet Yellen and look at this fantastic job she's done. And so you have all these different narratives out there. And the stock market, for example, or other types of markets don't necessarily behave in any way necessarily related to any particular one narrative. The markets do what the markets want to do.
Exactly. And the market, you can't invest in the market as you wish it would be. You have to invest in it as it is. And I think a lot of people have trouble with this. And you talk about these narratives. I think people really prefer these emotional stories to just sort of an accurate data set. And so in my book, I talk about how there was a study done by Dan Ariely, who I believe you've had on the show before. And they looked at these 100 items that people bought at garage sales. And what they did with these items is they put them on eBay, and they did it side by side. And these were just simple items like an oven mitt, a jar of marbles, just very basic items. And what they did is they had these professional writers craft a really deep and detailed backstory narrative. And they had these items that they bought for like $100 sell for almost $4,000 on eBay because they had this narrative attached to it. People really just prefer a story to really looking at the hard data and figuring out what it means. I think it's easy for people to really fall into the extremes, that it has to be all or nothing, whereas the markets are usually kind of in the middle. They're not black or white. There's always a shade of gray there, and it's never going to be as easy as a binary decision usually.
You just went exactly where I wanted to go, which I believe this was actually called the Significant Objects Project. And the phrase that I saw that was great, which is narrative transforms the insignificant into the significant.
Yeah, and it's crazy, and it's why these poor investment strategies, people continue to seek them out, and people continue to make mistakes in the markets. There's a ton of evidence going back, hundreds of years that shows what has worked in the markets. You can see the evidence, but that doesn't make any difference to people. Warren Buffett has been telling people to have patience and discipline for 3 or 4 decades now. And it doesn't matter, because the problem is that what I say in the book is that knowledge alone is not enough to change your behavior. Everyone knows how to lose weight. Everyone knows that quitting smoking is probably a good idea for them, but they don't know how to change their behavior because, again, they allow emotions to dictate their actions.
You bring up Warren Buffett. I think there's some interesting data in your work. Some people may or may not be familiar with it. The success, everyone knows the success, a tremendous success, almost unparalleled. I don't know that there are other people that we can kind of fit in and say, oh, here's Warren Buffett number 2. He's kind of like the main guy. One of the things that has happened throughout his career is he's had, to use a term from my world, he's had drawdowns. He's had, I believe the number is 4 over 30% down periods since 1980. Is that correct?
Yeah, that's what I looked at in the book, and 2 of them were, 50% right along with the market. And the thing is that, Buffett and some people can't take those kind of drawdowns. So let me get that out right away. Not everyone has the patience or the capital to sit through a drawdown like that, like Warren Buffett can. But he's really defined his process over the years and said, you know what? I'm perfectly fine sitting through a drawdown like this because I know that I'm going to hold through it. I'm going to wait until things come back. I think that's what people don't really understand about their own system of investing is people say, I've learned my lesson. I saw the tech bubble. I saw the great financial crisis. I'm not going to be tricked this time. But then they don't have a plan of attack for either pulling a Buffett and sitting through it and having that, if you have a decade, multi-decade time horizon, I'm going to sit through this, because guess what? If you're an investor and you have, say, 40 years to invest, you're going to have a couple of these enormous crashes. It's part of the way that human nature works. It's going to continue to happen over and over again. And just having a plan in place, one way or the other, for how you'll react to it is really huge. And I think that's something that most people don't have.
Without even getting into a particular strategy, I think the audience can have a general feel for where you're going. You're pretty safe, pretty pragmatic guy. You're not telling anybody to go do anything, wildly outlandishly alternative. But if I was to make some pushback, if I was to give some pushback on something like the Nikkei, so we're still, about 50% down from a high in 1989. Does that kind of, even though I know you would come back and say, hey, well, Mike, look at the history of America. Look at this. We take these 50% hits from a buy and hold perspective and we come back. But is it unreasonable for some of the audience to say, but Ben, how do we know we might not fall into the Japan stock market? Or do you see what I'm saying? It seems like that there can be some legitimate pushback to some of the quote safer strategies, and that you could end up in a multi-decade situation where you're still down 50% from your high.
Oh yeah, it's a perfectly valid, and I think, because a lot of the way they say the winners write history. So people look at the U.S. and say, oh, it was obvious. People should invest in the U.S., over multi-decade periods and they'll be fine. But I think what the Japan scenario shows is not just that, buy and hold might not work. I think what it shows is the importance of having a diversified strategy and not putting all your eggs in one basket. Because if you're an investor in Japan and you have 100% of your portfolio in Japanese stocks, since 1989, like you said, you're out of luck. So I think what it really shows is the fact that, no one really knows what the future is going to hold. And it's kind of easy to look back at Japan now and say, this is the greatest bubble we've ever seen, potentially. PE ratios of 100 times, the real estate of, Tokyo worth more than California, all these things. But I think what it really shows is that people have to have a diversified approach if they're going to practice that strategy. Because you can't just put your money into something and hope for the best, because, again, no one knows the future, no matter what they tell you. And so I think if you're going to use a buy and hold strategy, which I say in the book, kind of using the Churchill quote, it's the worst way to invest except all the other ones. But I think it's kind of a good starting point for people who want to, compare on a relative basis. Should I be trying something different, or should I make things easy on myself and do sort of a diversified buy and hold, where I keep things very simple? So I think it's just more of a jumping off point for people to figure out whether or not they can or should, take an extra step and add some more diversification by strategy and that sort of thing.
Well, you bring up an interesting point to following on my Nikkei comment, which is from an American perspective, international diversification here. So I'm calling you from Asia today. I can't help but look at the growth and the opportunities, but I still can't say that the market structure and the ability to get liquidity, it's not exactly the same for those in America that might have a Schwab or an E-Trade account. And if they want to get out, they can get out. I mean, we can all see what has happened in China in the last few months. And now China could come back and say, hey, hold on, Mr. Mike and Mr. Ben, look what you guys did in the fall of '08. That wasn't exactly, liquidity and free markets and all that kind of stuff. But I think the international diversification seems like a great place to be. But I would love to hear your opinion on the efficacy of it. I mean, how close we are to it really being truly a great opportunity for Americans, for example.
Yeah, and I think it's something that, investors have to really set their expectations, because when you go internationally, you're also adding the element of currency fluctuations to it, and that can really kind of add an extra element of volatility that a lot of people don't realize. But I mean, the thing that people have to realize, and I'm going way back here, is that the U.S. was once an emerging market. We weren't always this mature, world-beating economy, and now, I mean, I think the U.S. has a lot of different benefits, and competitive advantages over some of the other countries in the world. But there's nothing that says that over the next 100 years that the U.S. is going to continue to be the world-beating stock market. I think the whole diversified approach in thinking globally is just more of the fact you're saying that, I don't know what's going to happen in the future, either market-wise or economically. And so I'm just going to kind of hedge my bets and really spread it around to a lot of different markets, because eventually, the emerging markets, especially, we're talking internationally, are this very big boom-bust cycle. And it's continued over the years, and you see it almost with regularity that it's just bound to happen. So I think people just have to really understand and set their expectations right when they're diversifying internationally, and figure out how much of that sort of tracking error they can take from the U.S.
To add to your point of diversification, it's kind of like venture capital in a way. I mean, you don't know where the winners are going to come from. You have to be able to use your phrase, softening the blow of the losers. So, I mean, diversification it's the only free lunch, right?
Yes, yeah, exactly. And yeah, like you said, if people always talk about having a best ideas portfolio. Well, if everyone knew which one of their best ideas was going to outperform, they would just invest in those. But, you really don't know. Even some of the best investors with these very concentrated portfolios, like you said, like a venture capital, they don't know which ones are going to completely crash and burn and which ones are going to be a 10x for them.
Let me give some one-liners at you and let you kind of tear some things apart here. So for the life of me, I'm still trying to figure this out. What's the purpose of a long-only commodities investment? Just a pure long-only commodities investment, no strategy, just long-only, quote, commodities. What's the purpose of that?
Yeah, I think a lot of people, especially in the mid-2000s, after they saw the stock market crash from the tech bubble, and really when China took off and Brazil and all these emerging market countries, we had an enormous commodities boom. And there was a few papers that were written around that time that kind of looked back and showed if you had a long-term commodities future exposure, you could get the same returns as stocks with just a little bit more volatility. And I think all these people really bought into it. But what they were buying into was the fact that we were just in a boom. And people have now come to realize that commodities are not a long-only strategy. And one of the reasons is, if you think about it, a bet for commodities is something of a bet against human ingenuity and innovation, because we're constantly looking to make these things cheaper and easier and find different resources. Having that long-only, I've always thought that commodities are much more of a trading strategy, because the boom-bust cycle is even bigger than, say, like the emerging markets. And those bust cycles can last a long time. If you look back to, say, 1990, when the Goldman Sachs commodity index was put into place, the returns of that are similar to what you would receive in T-bills, which is, cash. But the volatility is the same as the stock market. So I think people really bought into the commodities long-only index when they were really doing great. I think they've come to realize that it's not an easy way of doing things, and that there's a lot of speculators out there who can really sort of get in front of them and make things a lot harder than it is to just, say, sort of buy a long-only stock index.
It is one of my most favorite words, though. I do like speculation. It's sometimes used as a pejorative out there, but I think on a pure base level, speculation is a good thing. I think if you have speculation with no strategy, no plan, then you potentially have a future problem.
Right. And that's one of the things I say in my book. My definition of speculation is not having a plan in place. So like you said, it really depends on what your system is. And I saw a quote this week from Jerry Parker, who again, that's another guy I believe has been on your show. And he said, any system is better than no system. And that's why something like the S&P 500 beats most people. A lot of people have a hard time beating it. It's not that it's anything special about this index fund. You know, index funds are nothing special. It's just a disciplined approach. And that's the whole thing, is that people just need to have a plan in place. They need to have some sort of system that guides their actions.
Yeah. And I mean, you can have, of course, guys like me and you, we could open up and spend hours debating particular types of systems. But I think the commonality in a belief is have a system. And I think one of the ideas that systems opens up too, and you talk about this issue, and I'd love for you to expand on it, risk and reward. I mean, they're tied at the hip. You don't get the big reward without putting extra skin in the game. It just doesn't happen magically. You might get lucky. You might hear about something in the paper or in that great noise cacophony that we're talking about today, but it just doesn't happen. The big reward comes from the big risk, and the big risk doesn't only necessarily give you the big reward, it can give you the big loss. Yeah,
exactly. And I think that's another holy grail that people are searching for, is that they want that low risk, high return strategy, which doesn't exist. There's always risks. If you try to hedge one piece of your portfolio, you're potentially exposing yourself to other risks that you probably don't even realize, because there could be unintended consequences. People have to realize that it's more about the long-term process than the short-term outcomes, and that dealing with losses or drawdowns, or even relatively underperforming the market and sitting out some gains, depending on how you're investing, you have to just be comfortable with how your plan and your portfolio looks, and not be tempted to continually search for that holy grail.
There's still a good part of the investing world that really thinks certainty is possible.
Oh, definitely. And that's one of the things that why they buy into the narrative so much. When people see someone go on financial television on CNBC or Bloomberg, and they hear this person who works for one of these big financial firms, and they go and they give their forecast of what's going to happen, they sound so sure of themselves that it's so easy for people to believe. But then you could see the same guy next week say something completely different, because again, no one knows. It's true. I think that's one of the hardest things for people who are not inside the world of finance to realize, that there are a lot of smart people that work in the markets and investing and in finance and portfolio management, but being a very smart person, and some of the most brilliant people investors over time, are some of the ones that have had the most glorious flameouts and they've crashed and burned. So I think that we really want that illusion of control, to think we know what's going to happen. But again, no one does, and it's really hard for people to admit that.
Let's talk about a moment the pros, and you're in this pro world too. I still think to myself, one of the ideas that I had when I was contemplating putting a book together about a decade ago, I was thinking to myself, one of the most interesting things I have for the topic that I'm writing about were these audited track records on file with the government. And I thought, well, this is just terribly interesting. It doesn't mean that the past will be like it has always been and everything will go off into the future. But when I could look at decades and decades of data in a particular strategy, I thought that was terribly interesting in terms of vetting a pro or even vetting a strategy. I look at now in the last couple years, I see AQR has come back with a very long study looking at trend following strategies, for example. And I just think this idea of vetting the pros is not something that I see people instinctively reach for. Instead of vetting a pro, I find so many people just trust a pro. And I always go back to the thing Reagan and Gorbachev. Trust the nice guy you meet in the great suit in the great office. Trust him like hell, but verify him like hell.
Right. Yeah, it's true. And again, that's one of these things where we get in front of these really smart people. And I've seen it before where these people say they have these really deep due diligence processes, but then they get in front of a really smart portfolio manager and they just sort of melt, and they just kind of say, here, take my money, do whatever you want with it.
You see that though. You literally see they lose all sense of due diligence and just roll over.
Yeah, at times it's true, because some of these people that have been able to raise billions of dollars for their funds, they didn't do it because they're dummies. They are very smart and impressive people. But one of the things is that they have that certainty that you say, and they really talk about their gut instinct, and they know what's going to happen next. And it's hard for people to not have that illusion of control. And I like what you say about the evidence thing. And I think one of the most important things there is not only having a sense of what has worked in the past and following that evidence. That's actually one of my, philosophical beliefs, is that, I'm very evidence-based. But I think the next step is not only what has worked in the past, but why will it continue to work in the future? And for me, that always comes back to the behavior of people. I think you can look at all the academic textbook information you want and talk about Sharpe ratios and risk return and all these things and volatility. But really, if you want to have a successful investment process, you basically have to be taking advantage of someone else's mistakes. And so I think understanding that behavior of other investors in the market is one of the big reasons why you can really have some confidence, not 100%, you're never going to know for sure, but some confidence that a process can continue to work in the future.
So the only way Kahneman's work could ever be invalidated would be if everyone willingly got themselves into some type of a system. I think of all the work out there related to finance and investing, I think one of the best bets that I could see going forward in the next 100 years would to be bet on the work of thinking fast and thinking slow.
Right. Yeah, you're right. And like you said, it's not like it's a big secret these days that people can find this stuff if they want to. There's been thousands and thousands of books written by, very successful practitioners. But again, people have a hard time, again, changing that behavior. It's not just the knowledge. It's not, I know this system will work if I give it time to do it. But people just don't give it the time to work, or they don't have the discipline, or maybe they don't understand exactly why it works. And the biggest problem for most people is that doubt creeps in when you have a period of relative underperformance or losses, or something's not going right, and you start looking around and saying, does this still work? Why should I continue to follow it when it hasn't been working recently?
Today, Ben, there's a lot of other things that we can talk about. We've not really dug into asset allocation. You bring up 7 important questions in your work, but I think one last thing, I think people should definitely check out your work and dig in deeper. But one last thing I wanted to kind of bring up, and I guess for some people it would feel controversial, whatnot, but I hear this phrase market timing, the phrase prediction, and we can look at almost any type of media, financial media, investing media, and on a daily basis, there is someone put in front of the screen, smiling, usually with a great lower third on the screen that says they're really smart and really successful and they're with a great firm, and with the utmost professionalism and just the greatest of confidence, and they just look into that camera and they say, I know what's going to happen tomorrow, or if this happens, I can predict this. And it's mind-numbing to me still, and I guess it keeps me. I think this particular issue that I'm driving at, I think motivates you too, because I think you love to lampoon it and pop it as much as you can. But this just never stops. There's such a significant part of the Wall Street machine that is just peddling absolute trash with the greatest of confidence, and it's like a waterfall. It's like Niagara Falls. It never stops.
Yeah, and it's probably never going to, because people continue to believe in it and buy it. And unfortunately, I think there are a lot of people out there who don't understand that they shouldn't be, following this. But there are those other people that want to believe, and they sort of suspend reality and really just follow whatever anyone else says. Yeah, I think that one of the biggest issues for individual investors is really sorting through the noise and figuring out what constitutes a good source of advice. Because most people just ask a friend or a family member, can you recommend someone? And the first person they're put in front of, they just sort of take them at their word. And I think that, I'm not out there to say that everyone in finance is out there to get someone and they're all liars and cheaters. But I think that there are a greater number of those sort of liars and cheaters, whether they know it or not. And I think a lot of it is really driven by incentives. I always think if you want to figure out why someone is doing something, it always goes back to their incentives. And so I don't think people are trying necessarily to really pull the wool over someone's eyes, as a portfolio manager or a financial advisor. I think that in many ways they're incentivized to do that.
I want to end with a great quote. And as you've mentioned, a couple of people that have appeared on my podcast, I was going through your book and I was like, well, okay, more than a few people have appeared. But you've got a great quote from behavioral economist Meyer Statman, who has appeared on my show. And he says, quote, financial advisors frame themselves as investment managers, providers of beat the market pills, when in truth, they are mostly managers of investors. Is that another way for saying that many investment advisors are shrinks to their clients?
Yeah, they almost have to. And he has another great quote that I just used recently. I love his work, where he said, financial advisors are not managers of money; they're managers of people. And it's so in a lot of ways, you almost have to act as a behavioral counselor to your clients. And I think one of the more overlooked facets of being a good advisor or a good steward of someone else's capital is the ability to communicate and really break things down to simple, easily understandable words that people can know what you're doing and why you're doing it. And I think that's one of the biggest problems in finance, as far as the simplicity thing goes, is that, people are trying to talk over others' heads instead of really just breaking things down and making it so they can really understand and know what they're doing and why they're doing it.
And Ben, you're very comfortable today with the fact that for that audience out there that's been listening for 45 minutes to an hour, you're very comfortable with the fact that you've not given anybody a secret. You've not given anybody this is how it's going to work. Because somebody out there is going to be sitting there and saying, oh my gosh, these guys didn't tell me anything. I didn't learn anything. I didn't get any, quote, actionable advice. If I could, I don't know, lobotomize anyone that uses the phrase actionable advice, it's ridiculous. I mean, but that's the whole point. It's a process. It's a philosophical discussion. And if it doesn't start with a philosophical discussion, everything else that comes after is that's the one prediction that you and I can make. If it doesn't start with a philosophical discussion, what comes next is an easy prediction.
Right. Yeah. Everyone wants tactics, but they don't want to have that big picture overarching philosophy that can sort of guide their actions. And one of the biggest aspects of that philosophy in my mind is having the ability to say no and knowing what not to pay attention to, and knowing that even if this sounds like a very good investment pitch, it may very well be, but it doesn't work for me. And it's not going to help my portfolio because I'll be up all night worrying about it. And so I think it's that philosophy is so important to get that context and then having the ability to frame it for your own situation.
We can send people today to, you're in a new place. I know some of the guys there.
Yeah, so I just about 6 weeks ago started with Ritholtz Wealth Management, so Barry Ritholtz and Josh Brown's firm. So I will be helping them build out an institutional practice.
Cool. So are you in New York?
Yeah, so I'm actually based in West Michigan. The firm is based in New York. I travel there occasionally, but like you said, the technology makes it so easy to kind of work from anywhere these days that I'm actually our Midwest office now.
I'm going to have to, my last conversation with Barry, talk about time flying, because I've been in and out of Asia for 3 years, but we had a nice lunch in Vancouver a few years back. It was kind of before I had come to Asia. One day I'm going to have to get Barry over to I don't think he's been to this part of the world yet, but I got to get him over here.
Sounds good. Yeah. And he's a good person to have on the show too.
And so is it in the best website for everybody to go check things out?
wealthofcommonsense.com is my blog.
And the book is on Amazon.
Yep, book's on Amazon, same name, Wealth of Common Sense. Should be able to find it anywhere that sells books.
Ben, I appreciate it. Nice, pragmatic, very straightforward, easy conversation. But it sounds easy, but the depth's there for those people that kind of get that. But some people are going to want the actionable advice and they're going to call us names, but that's how it goes.
Yep, thank you.
Thanks, Ben. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.